This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the last of the series of lectures on foreign exchange risk management. And in the earlier lectures, we've talked through various ways in which you may remove the risk due to exchange rate movements, things like invoicing your own currency and so on. And the two calculations you can be expected to perform on using forward rates and money market hedging. However, there are other methods available, futures, options, swaps, which you're expected to be aware of for the exam, expected to be aware how these work, what they are, but you cannot be asked calculations in paper F9. In paper P4, when you come to it, yes, and they can actually get quite messy. But in paper F9, no calculations, albeit I will go through one or two simple examples just to illustrate how they work. I think it makes it a bit clearer than just talking. But again, you cannot be asked to do the calculations yourselves. The first one I want to explain are financial futures. And strictly, futures are a bit like forward rates in that there's a rate quoted now which will apply to converting money on a future date. You know very well from what we did on forward rates, the bank will give you an exchange rate now to apply in a month's time or 2 months' time or whatever you've asked for. With futures, they give you a rate now for conversion on a future date, but it's only set dates. Futures, you can get a rate quoted for conversion at the end of March, the end of June, the end of September, and the end of December. So they won't give you a rate for changing in a month's time or 2 months' time. They'll quote a rate now that applies to a transaction either at the end of March or June or September or December, the last day of each of those 4 quarters. And so on any one day, there'll be 4 futures prices quoted. You know, it may be that today the spot rate is dollar pound 1.5000. Well, to convert money at on the last day of March, we call it a March future. They might quote, for conversion at the end of March, we'll quote you a rate of 1.5100 for a June future. If you want to be able to convert at the end of June, maybe they're quoting 1.5200 and so on. Now that makes it fairly restrictive because obviously, although it's in that sense like forward rates, it's only really any direct use if your transaction is going to happen at the end of March or the end of June or the end of September or the end of December, which is rarely going to be the case. Clearly, it may now be January. I may be wanting to convert money at the end of February. But these rates they're quoting will only apply, again, to converting at the end of March, June, September, and December. And so in practice, few people use futures in that way. Because the important thing is that futures are traded on it's like the stock exchange. There's a financial futures exchange. The biggest one is in London International Financial Futures Exchange. They're traded on an exchange, which means you can buy and sell futures. Just like you can buy and sell shares. Because the prices will change. You know, today, spot rate is 1.50. Maybe if we came back next week. Obviously, the spot rate stands to have changed. Maybe in a week's time, the spot rate may have changed to 1.6000. And equally, the prices they're quoting for these futures, conversion at the end of March, conversion at the end of June, and so on, they will have changed as well. Want to convert to the end of March? Fine. Today, they'll quote you 1.51. Maybe next week, they're quoting 1.62. Maybe June futures, they're quoting 1.63, and so on. Just as the spot rate changes from day to day, so too will the futures price. They're two different things. The futures price is a rate they're giving you for conversion at the end of March. The spot rate is the rate for converting today. But again, as spot rates change, the rates they're quoting for the futures will change. And as I say, because they're traded, you can buy futures and you can sell futures. And in fact, a lot of people use them for speculation. Suppose I think that the dollar is going to get stronger. Well, fine. I could buy lots of dollars and hold them for a few weeks and then sell those dollars. And if I'm right, I'll make a profit. But of course, exchange rates then tend not to move a tremendous amount. And so to make a decent profit, I'd need to buy millions, perhaps I'm exaggerating, but I'd need to buy a huge number of dollars. Well, futures, the nice thing is you can buy and sell futures. And so if you buy at one price and sell at another price, you've made a profit. If the price has gone down, you make a loss. But futures are rather beautiful in that, I can buy $1 million of March futures, but you don't actually have to pay for them. It's just a phone call. You say, I'll buy $1 million of futures, and then a week later, 2 weeks later, I sell $1 million of futures. And it's only at the end of the deal that we settle up. It's just a phone call. Ring up and say, I'll buy 1 million March futures at 1.51. Next week, the price has gone up. I'll sell them at 1.62. And it's only at the end of the deal that they'll calculate the gain or the loss. And if there's a gain, I'll receive the profit. If there's a loss, I'll have to pay in. So you can actually, with futures, gamble, and it is pure gambling for a lot of people. You can gamble on the price. I say again, you can gamble on currency as it stands, but to make a profit at spot rate, I can't afford to buy $1 million and hope the price will go up and I make a big profit. But with futures, because you only settle up at the end, I can ring up and say, I'll buy $1 million of futures. And if the price does go up, fine. I get paid the profit at the end. If the price goes down, I pay in the loss. So that's what makes them really attractive. Okay, I'm going a bit too far here for F9, but the dealers will want a big deposit at the beginning. I couldn't just ring up and say, I want to buy $1 million of futures. They need to make sure that, I can actually afford to pay in if there's a loss. And so they will demand a huge deposit from me. But I'll get that deposit back at the end, together with whatever the gain or the loss is. Now, as I say, a lot of people use it to speculate, to gamble. They buy futures, they sell futures. All right, they risk making a loss, but they hope they'll make a profit. Financial managers, though, their job isn't to gamble, but financial managers, I'm about to show you how, but they can use futures as a way of hedging, cancelling, removing the risk on our transactions. And just to show you what I mean, look at example 8. Now remember, you can't be asked the arithmetic, but this is a very basic example, just to hopefully make it clear how they work. R is in the US, so appreciate here, our company is in America, they deal in dollars. However they're trading abroad, we need £800,000 on the 10th of August. Today, if you look further down, it's the 12th of June. But we're going to need to convert into £800,000 on the 10th of August. Now, if we were to convert today, then of course we convert at today's spot rate. Now remember, we're in the US. So if we were converting today, which is what, 12th of June, then of course again, we'd buy those pounds at today's spot rate. And the spot rate is 1.5526 to 1.5631. Now this is dollars to the pound. So £1 will cost us 1.5 something dollars. And so since we need to pay this, we need to buy £800,000. Surely when we convert to dollars, we use the higher rate. We're buying pounds, we're selling dollars in order to buy pounds. And so if it's 1.56 dollars equals £1, we'll multiply. And it means the cost in dollars, if we were converting today, would be $125,0480. Well, that's fine, except of course we don't want to convert today. We don't need the money until the 10th of August. And so, again, we don't want to convert today. We want to pay out the money sooner. And we're going to use futures. And what we do is this. The transaction itself, we leave it at risk. Leave the transaction at risk. And what I mean by that is that we'll convert at whatever the rate is, whatever spot is, on, in this case, the date of the transaction is 10th of August. So transaction itself, we don't do anything. We leave it at risk. On 10th of August, we'll convert on whatever the spot is. And of course, the spot could be anything. It could be better for us, it could be worse for us. To illustrate, it says, assume, look at the last line, assume the spot rate increases by 0.02. Well, today it's 1.5631, the relevant rate. And so we'll convert. If it had changed by 0.02, it would change to 1.5831, 1.56 plus 0.02. And so how much would we have to pay? 800,000 times 1.5831. These are payments, appreciate. So we'd have to pay 1,266,480. Now, of course, we've no idea in real life what the spot's going to be on the 10th of August. We could end up, as here, having to pay more, Or it could have gone down and we end up having to pay less, but we've left it at risk. And what do I do about that risk? Well, the point is this: there are futures available. There are September futures available. That means that we could use this to convert at the end of September, but we're not. We're going to do this buying and selling. They're available today at 1.5580. And so today I'll ring the dealer and I'll say, buy me $800,000 worth futures today at whatever today's price is, and it says the price is 1.5580. That's the rate effectively quoting if you wanted to convert it into September. However, we buy those futures today, and remember, we don't have to pay for anything. We just have to give a deposit. But from then on, day by day, as the spot rate goes up and down, so too will the futures quotes go up and down. And so we ring the dealer and say buy. And then on the date of the transaction, we sell them. And the date of the transaction here is on the 10th of August. So make sure you're with me. All I do today is ring a dealer and say buy futures. And then we just sit back. And when it comes to the date of the transaction, I ring the dealer and I say sell the futures. And depending on what price the futures have changed to, whether the price has gone up or down, if there's a profit, I'll get sent the profit. If there's a loss, I'll have to pay it in. And so what's going to happen here? It says again at the bottom, assume that the futures price increases by 0.02. And so we'll sell these futures at whatever the price is on the 10th of August. And if it's gone up by 0.02, it'll have gone to 1.5780. The price has gone up. We've made a profit. And so we'll receive from the dealer the gain. What was it? It was $800,000 worth of futures. And the dollar value, sorry, £800,000 worth of futures. I do beg your pardon. It was £800,000 we needed to pay. And the dollar value, when I bought, was 1.558. The dollar value has gone up to 1.578. The profit is the difference. The profit, of course, is 0.02 cents on every pound. Every pound was quoted at $1.57. Every pound, at $1.55. It's now quoted at $1.57. And so we've made a profit of 2 cents on every pound. And £800,000, 2 cents per pound. We've got a profit of £16,000. And so there's two separate things here. On the transaction itself, converted to whatever spot happens to be, and we pay out 1.266 million. On the futures deal, at the end of the deal, profit or loss here, a profit, 16, we receive that from the dealer. And what's the net effect? We end up paying out 1,266,480. We receive 16,000. The net effect, net cost, net payment, 125,0480. which of course is what we'd have had to pay if we'd have converted now. We're not going to convert now. Conversion takes place on the 10th of August. But there are two deals going on. As far as the transaction's concerned, clearly by 10th of August, the exchange rate may have gone up, it may have gone down. As a result, we may be paying more, as we're doing here, or we may be paying less. We don't know in advance what's going to happen. But separately, we've got this futures deal. And although the different quotes, the futures are a quote for converting in September. But as the spot rate goes up and down, so too the futures quote will go up and down. And so, completely separately, we've entered into a futures deal. And as the futures price goes up and down, the futures make a gain or they make a loss. And so we've used one gamble, in a sense, to cancel the other one. See what's happening, you see, as the spot goes up and down, we make a gain or a loss. Here we're losing money because we're paying more. But at the same time, our futures deal, as the price goes up and down, it's making a gain or a loss. So here, things have moved such that the transaction is losing us money, but the futures are gaining us money, and the two effects cancel out. Equally, had the exchange rate gone the other way, had the exchange rate gone down, the futures price would have gone down. And so we'd be paying less on the transaction, we'd be gaining, but we'd make a loss on the futures. And again, the two effects would cancel out. We're using one risk to cancel the other risk. So it's neat. As I say, you get a lot of people purely gambling on futures. That is not the job of the financial manager. Their job isn't to gamble. Their job is to hedge the risk. But again, they're using the risk on the futures to cancel the risk on the transaction. So that's the way it's working. And appreciate, I have said, but let me repeat. As of today, 12th of June, all we do is make a phone call. Buy £800,000 worth of futures. All right, we have to pay a deposit. And we'll get that deposit back at the end. But otherwise, that's it. It's a phone call. It's only when we come to the date of the transaction that we then do what we've done there. The transaction itself converts at spot. And again, we may end up losing out, we may end up gaining. But on the same day, we finish our futures deal. We bought at one price, right, on the same day we sell the futures. And if there's a profit, we receive it. If there's a loss, we have to pay it in. So that's the way it works. Yet again, you wouldn't be asked to do that transaction, but I hope that makes sense. I have written a note at the bottom. In real life, things aren't quite as perfect as that for two reasons. One is, with futures deals, you can't just buy any amount you want. They have to be in what we call fixed size contracts. And so it depends what's being quoted, but they might say, for instance, futures can only be dealt in units of 150,000. In which case, we wouldn't be able to do it on exactly 800,000. 150,000 doesn't divide. We'd either have to deal in slightly fewer futures or a few more futures, and it wouldn't end up balancing exactly. The other problem is that for this example, because it was just meant to be a simple illustration, we assumed that spot and futures prices would both change by the same amount, here 0.02. Well, in real life, It's a very efficient market, futures. And so futures prices do go up and down as spot goes up and down, but they don't go up and down by exactly the same amount. You know, in real life, the spot rate may go up by 0.02. The futures price would go up, but it might go up by, instead of 0.02, it might go by 0.019. And if you think about it, if the futures price doesn't move by exactly the same amount, then it won't exactly fix the net amount. There'd still be an element of risk. Now, those are things you can deal with at P4, but not here. What matters is this principle that the transaction is left at risk. To remove the risk, to cancel it, we enter into a futures deal where we've got a compensating risk. The risk on the futures cancels the risk on the transaction. Okay, so that took a while, but there we are. And the end result is that, subject to the points I just made, the end result is that we do more or less fix the net payment that will occur on, in this case, 10th of August. We end up, apart from that little problem I mentioned, we end up neither gaining nor losing. I mean, I say again, if the exchange rate moves against us, we're losing on the transaction, but we'll be gaining on the futures. Equally, if the exchange rate went in our favour, if it had gone down, we'd pay less, we'd gain on the transaction, but we'd lose on the futures. Again, we are more or less fixing the net payment. All right, well, that was a long one. The next one is pretty quick, is options. And what this is, if you think back to forward rates, a forward rate was a rate they quoted now to convert on a fixed future date. And I did say at the time, if you've agreed to accept this forward rate, you have to convert at that rate. It's irrelevant what happens to spot. Whether the spot's gone up, gone down, whether we would have gained or lost at spot. If you're using forward rates, you have to convert at that fixed rate. Now, okay, that's good because we now know for certain what we'll pay. But of course, if the exchange rate did move in our favour, we'll say, oh, what a shame, you know, what a pity we bought, what a pity we accepted this forward rate. We'd have been better doing nothing at all. But, you know, we never know whether it's going to move in our favour or not. And if it had moved against us, then, of course, we're really glad we went for the forward rate. Well, what options are is quite neat. An option is the right to convert at a fixed rate. On a future date. So very much like a forward rate, they give you a fixed rate for conversion, 1 month's time or whatever. But the big difference is it's the right to convert. You don't have to. It's our choice on date of transaction. Whether to what we call exercise the right. Or to convert at spot. We wait until the date of the transaction. And at the date of the transaction, we say, oh, which will be better? We look at what the spot rate is, and we say, well, which will be better? Shall we convert at spot? Or would it be better to use this fixed rate? Which is brilliant. If the spot's moved against us, if it's gone worse, fine. We've got the right to convert at a fixed rate and we'll use it. But if the exchange rate has moved in our favour, and its spot rate is better, then we'll convert at spot and we just throw away this option. With forward rates, you have to convert at the agreed rate. With options, it's your choice. You do whichever is better. So, of course, you can only win, you can't lose, which seems too good to be true. But the downside is we have to pay for the option. It's called a premium. And we have to pay for this option. It's a bit like insurance. We have to pay for it whether or not we use it, or whether or not we exercise it. So again, even though, as I keep saying, you cannot be asked numbers, let me a very simple little illustration, just to hopefully make it clear what I've meant by all that. Look at example 9. It's the 1st of April. X plc in the UK expects to receive 2 million on the 30th of June. The current spot rate is $1.5190 to the pound, and X expects that this rate will move in their favour. So, although we're not going to convert now, if we were, to receipt, we'd divide 2 million by 1.5190. We think it'll move in our favour. And if it does, we'd receive more. We don't want to have a fixed rate if it moves in our favour. However, of course, we're never sure. Whatever I may expect, in a sense it's a guess, and it may move against us. We've purchased from the bank an option to sell $2 million on the 30th of June at a price of 1.52. So we purchased the right to be able to convert on the 30th of June at 1.52, and the bank have charged us $50,000 for that right. And it says, A, show the outcome on the 30th of June if the spot rate on that date, first of all, is 1.5180. Well, when it comes to the 30th of June and we see what the spot rate is, it's our choice. We can either convert at spot, 2 million divided by 1.580, or we can exercise the option. Which would, we were have the right to convert at 1.52. And so what are we going to do? We do whichever gives us the most money. Remember, we're receiving money here. And so we want whichever gives us the biggest receipt. If I convert at spot, I'll divide by 5.18. If I convert at, use the option, I'll convert at 1.52. I'll be better to use the spot rate. We will not exercise the option. We'll convert at spot. And therefore, what will we receive? It's $2 million. Converting at spot will give us 2 million divided by 1.52. 1.518. It'll give us £1.317523. The exchange rate had moved in our favour. If you're unsure, have a go. See what would happen if you exercise the option. You divide by 1.52, you'll end up with a lower receipt. You were better to convert at spot because it had moved in our favour. So we won't exercise the option, we throw it away. But of course, even though we're not using it, we did have to pay the bank a premium. We'd have had to pay, how much was it? 50,000. Even though we're not using it, you still have to pay the money to have had that right. One small point, which I doubt will be relevant in F9, but the receipt itself, you know, it's only on the date of the receipt, 30th of June. It's only on the 30th of June that you make the decision and that you actually get the cash, or if you were paying, pay the cash. The premium, though, was paid right at the beginning when you first bought the option. We haven't got it, 1st of April. Today's the 1st of April. So the minute you go to the bank and say you want to buy this option, you pay the premium there and then. On the date of the transaction, then you decide whether to use the option or not. And so to complete the exercise, what about B? It's probably already obvious, but this time, show the outcome on 30th of June if the spot rate turns out to be 1.6153. And remember, our choice, we can always either convert at spot or use the option. The option was to convert at 1.52. Well, it's our choice, but remember we're receiving money. So I want to, whichever gives us the biggest receipt. And so which will we choose? Surely the bigger receipt would result from exercising the option. We will exercise. And therefore the receipt we'll get, it's $2 million. We're going to convert at 1.5200 because I'm using the option, and so we'll receive £1315789. Had we converted at the spot rate, 6153, the receipt would have been lower. So we will exercise it, and if you think about it, that is the worst that can possibly happen. If the exchange rate goes in our favour, as it did in Part A, we get more. The more it goes in our favour, the more we receive. But if the exchange rate goes against us, if it's anything above 1.52, we'll exercise the option, and that is the worst possible outcome. However, don't forget that although that's what will happen on the 30th of June, there would have been the premium payable. That was a receipt. There's a premium payable of 50,000, and that would have been paid immediately. So, of course, if the exchange rate goes against us, as it did here, we're very glad we paid the premium. If the exchange rate went in our favour, we didn't use the option. We wish we hadn't even bought it. But the problem is, of course, you never know in advance what's going to happen. But options are really good. You know, if you think the exchange rate's going to move in your favour, obviously you want to take advantage of it. But because there's always the risk that you're wrong, and like there, it will move against you. Buying the option is a bit like taking out insurance. Just as with insurance, you know, if you insure your car, you're hoping you never have an accident and the insurance money therefore is wasted. But if you do have an accident, then of course the insurance is protecting you. And same here. As I say, one bit of terminology, and just in case it's mentioned, is here we have the option to sell dollars at a fixed rate. Well, equally, if you were having to pay money, you can get an option to buy dollars at a fixed rate. And there are words for that. A call option, a call dollar option. This is the right to buy dollars at a fixed rate. On the other hand, if I wanted the right to sell dollars at a fixed rate, we call it a put option. So a put dollar option is the right to sell dollars at a fixed rate. So our example, we were receiving dollars, so we were selling dollars. The option we'd have bought would be a put option, the right to sell dollars. Now that could be mentioned. How you remember which is up to you. I think one of the study texts say, oh, call and buy, the first letters are close to each other. Whereas put and sell, the first letters are close to each other. I don't know, that doesn't make much sense to me. The way I tend to remember it is to say, oh, if I'm selling you this pen, I put it down. If I'm buying this pen, I call it in from you. But anyway, there we are. You'll see there 10.1 OTC options and 10.2 traded options. Options you can either buy directly from the bank, and that's OTC, it's called over the counter. And so what you might do, because they're going to charge this premium, you might try several banks and see who's charging the least. Obviously, the less you pay, the better. And banks can charge you what they like. You can alternatively, options are traded on the, well, like the stock exchange, but the currency exchange. And so instead of buying them from the bank, you can buy them from dealers. The downside is they will only deal in certain quantities for certain periods. But because they are traded, you're more certain of getting a fair price, a fair premium. But don't worry too much about that. It's a paper, again, P4, where we look in detail at traded options and it gets quite messy. Finally, currency swaps. Now again, the numbers can get quite involved, but you can't be asked numbers. And I've probably typed too much there anyway. I mean, have a read about it. But essentially what it is this. Suppose I'm in the UK, we're a company in the UK, and we're going to set up a subsidiary in America. I need to buy a factory in America, and I'm going to have to borrow money. Well, it would make sense if I'm investing in America where they use dollars, perhaps to borrow the money I need in dollars. But I don't have any credit rating in America. I'm a UK company. And so I can borrow at good rates in the UK, but in America nobody's heard of me. I might have to pay much higher interest. Well, what would be rather neat is if I could find a company in America that wanted to borrow pounds, because maybe they're building a factory in the UK. And they've got the same problem. They want to borrow pounds, but nobody's heard of them in the UK, and so the chances are they'll have to pay higher interest. They can borrow dollars cheaper because they're American, they've got a good credit rating. And so we've got this problem. I want dollars, but I'm in the UK, so they'll charge me high interest. The American company, they want pounds, but because they're American, for pounds, they'll be charged high interest. So why don't we do this? I'll borrow in pounds because I can get better interest rate. The American company, they'll borrow in dollars because they can get a better interest rate. And then we swap. And I pay his interest. You know, I wanted to borrow in dollars. Well, fine. I end up borrowing in dollars, but paying his interest rate is lower. And similarly, he pays my interest, so he ends up borrowing pounds. But at whatever interest rate I got it at, we both save money, we both pay lower interest. Now, of course, how do I find this other company who wants to borrow the same amount? Well, normally we do it through the bank. Banks have departments which will swap the money for you because they've got other companies want to swap it the other way. So think about that. I mean, read what I've written. But there we are. We've had a lot of lectures on foreign exchange risk management. I'm sorry. But the trouble is any one bit of that can be asked. The two bits of arithmetic, remember, forward rates, money market, hedging. Okay, that's it for foreign exchange. The other main bit of risk management is interest rate risk management. I'll explain that in the next set of lectures on chapter 24.